Amazon just announced that they're going to lay off approximately 14,000 employees from their corporate roles. Now, in this video, I want to explain what they've said and the reasoning behind it, but also tell you what they didn't say, so that you can be better prepared for what's to come, because it's extremely important. So let's get into it. This here is Amazon's release, and if I zoom in, you will see that they have said they will be reducing or getting rid of approximately 14,000 roles. Now, the reason they've given for that is effectively due to AI. They basically said that they're convinced they need to be a more leaner organization with fewer layers and more ownership to move as quickly as possible for our customers and business. In other words, what they're saying is they want to get rid of 14,000 roles and use that money to invest in AI and innovation. But here's the problem with that. As we are already starting to find out, AI doesn't understand its own outputs. It's all based on probabilities, and that is why hallucinations will never go away. That is why hallucinations will be a problem, and it's why companies like Deloitte are finding out the hard way that when you lean too much on large language models, it can produce hallucinations, and when you deliver that to a client, you're going to be giving them refunds. And so I don't believe that this is the only reason Amazon is laying off employees. I think it's a much more sinister reason that we all need to be aware of, because it will impact all of us. So the first thing that I want to show you is Amazon's latest release. Now, I know they're giving out their next earnings release this week. However, I want to show you their previous earnings, and that is from Q2 2025. Now, what I really want to show you is this: their AWS revenue from Q2 2024. It was 26.28 billion. And Q2 2025 was $30.87 billion in revenue. That's an increase of around $4.5 billion in revenue for the AWS cloud for the quarter. Now, why am I showing you this? Well, if we go to Alphabet's previous earnings release, you can see that year on year, their Google Cloud revenue went up from 10.3 billion to 13.6 billion, around $3.3 billion, which is less than Amazon's 4.5. However, Google Cloud is much smaller when it comes to revenue than Amazon. Less than half, in fact, it's more like around a third of their revenue. And yet Google Cloud is seeing higher growth. On top of that, let's go to Microsoft. And what do you see with Microsoft? Well, their intelligent cloud revenue went from $23.78 billion in 2024 to $29.878 billion. This is in the 3 months ended to June 30th for each year. So their revenue went up by around $6 billion. And they're slightly smaller than Amazon, yet they're growing faster than AWS. So what am I trying to say here? Well, I'm showing you that Amazon's cloud growth is actually the slowest of the three, especially when you compare it on a size-by-size basis. This is important. But we can even potentially see that ourselves, right? If you think about the AI that you do use already, like the large language models, what are the most popular? Well, OpenAI's ChatGPT is one of them. Right, on Microsoft, you're using Copilot, and they're pushing it out to us whether or not we want to use it. And on the other side, you've got Google and Gemini. Whenever you do a Google search, the first thing that normally pops up is a Gemini AI summary. And on your phone, you can also download the Gemini app. And so, and Amazon don't really have anything to compete against. They don't have something of their own that is as popular as Gemini and ChatGPT. So that being said, I believe that is one of the reasons Amazon is trying to get leaner ahead of time. However, there is another reason. And that reason is going to be a global slowdown that we're all going through. And let me show you the data behind this. The first thing that I want to show you is the UK's GDP growth. The UK's GDP quarterly growth is expected to be around 0.4% going into 2026. And yet, if you look at the UK's unemployment, it's expected to increase slightly into 2026 and hover at around 4.7, 4.8%. That's closing in on nearly 5% unemployment. Now, let's take a look at Germany, the third biggest economy in the world by nominal GDP and the biggest country in Europe. Well, guess what? They are currently potentially going through a recession right now. And for the last few years, their economy has not been doing great. You can imagine how this is going to impact retail sales. Now, if you look at their forecast, they're expected to grow. However, I believe they've been missing forecasts quite regularly. And so this might not come to fruition. And even if it does, it's very slow growth. Now let's look at their unemployment rate. And you can see here that it's expected to increase from 6.3% to 6.5% going into 2026 before potentially coming down and improving. Now let's look at the US. The US's GDP growth rate is forecast to actually slow down. So they're expected to still grow, but that growth is expected to fall quite substantially in 2026. Now keep in mind that even though in Q2 of this year, their quarterly growth rate was 3.8%, most of that growth came from the AI data center build out, which is still continuing into the end of this year. And so without that, the US's growth would actually be much less. And that is a very important thing to consider because yes, there is a clear slowdown in the growth of the US economy and in other economies around the world. Now let's look at the US's unemployment rate. And what you can see is the US's unemployment has been increasing since June of this year and is expected to increase into 2026. Beyond that, who knows, but it's clearly headed towards 4.5% and potentially beyond. Now, the last thing that I want to show you is the US's retail sales, and what can you see? Well, the retail sales haven't been that great, generally below 1%, closer to 0.5% in the last couple of months. And going into December, it's projected to be negative. Going into next year, 2026, it's projected to be fairly low. So very low retail sales growth. Now, why is that important? Because a large chunk of Amazon's revenue comes from retail sales. So if I can find Amazon's release, there we are. Let's take a look at this. Their net sales in Q2 2025 was from online stores was $61 billion, from physical $5.5 billion, and third-party seller services $40.35 billion. And they also get money from advertising and subscription, generally all related to Amazon's platform. So I'm showing you this because retail is such a large percentage of their revenue. And if we do see a slowdown in US retail sales, if we see a slowdown in the UK economy, if we see a continued slowdown or even recession in the German economy, these are going to impact Amazon's sales. And on top of that, they've got to compete with companies like Temu and Shein. So they're in a race to the bottom. All of them are in a race to the bottom when it comes to retail, which generally doesn't end well for anyone involved in that race. So I do believe, going back to the layoffs, that it's not just about AI. This release is to appease investors and to keep people invested. What they don't want are for all of their investors to start selling off their Amazon shares because they believe that Amazon's retail sales will suddenly start declining. Now, I believe that Amazon is seeing the slowdown and they're trying to stay one step ahead of declining revenue, or at least declining revenue growth, so that they can maintain their profit margins. But they're making it appear as though they're getting rid of people to invest in AI, because at the moment, that is all investors want to know about. AI, AI, AI. But like I said, I believe there is a more sinister reason behind this. So make sure you're prepared for what's to come. Keep your finances in check. Thank you for watching. Please leave a like if you enjoyed the video, and I will see you on the next one.